Chapter. We're talking real money.
I'm back. Did you miss me? Yeah, we had the Tom and Roxy Q&A last week, and we'll have some of those over the summer, too, because I'm going to be taking a bit of vacation time. There'll be podcasts, but I'm going to be traveling across the country, as you're probably aware. And so we're going to have some changes in the scheduling. For example, starting late June, the Monday podcast will vanish. Those will become, in essence, kind of vacation days for me. So we'll have Tuesday, Wednesday, Thursday, Fridays for a good part of the summer. But we'll have Q&As from me and from Tom and Roxy. This one's from me. Thank you for being a part of it. Please send your questions, and if you have questions about money, to talkingrealmoney.com or through talkingrealmoney.com on the contact form. And we've got now a lot again. They've suddenly just picked up. The numbers have grown, and that's terrific. Thank you so much for doing that. Let's get started with our very first one.
Hi, Tom and Don. I love listening to your guys' show and have for a long time. I've taken much of your wisdom and put it into action myself, managing my own money, but I'm trying to help out my aging parents. They're in their 70s, and they're beginning to show some signs of short-term memory loss. I am trying to make sure that they have a good advisor, 100% fee-only fiduciary you guys always recommend. But this is the first time I've tried looking into all of this stuff myself. The ADV Part 2, 12B1, etc. And it's honestly a bit confusing. Their advisor right now is called Horizon Financial. They got a CRD number 305239 in New York. I sent them your financial advisor disclosure form, but they didn't fill it out and rather emailed me back with a short description of their company and their CRS and ADV form. So they charge 1% assets under management, which I've heard you guys say isn't terrible. But it looks like they have like 92% of their assets they manage in individual stocks, and I believe some of their employees are both FINRA brokers, dealers, and SEC and advisors at the same time. I'm not really sure. Just want to see if I'm reading into this right. I've never done this before, so maybe you can help me, maybe advise me if I should seek an advisor for them, Appella or other, or how exactly to decipher all this legalese. I'm trying, and I think I'm close. I'm just unsure. So let me know. Thanks for all you guys, everything you guys do. I appreciate it very much. Thank you.
You asked this question almost perfectly. And this is great because it allows me to educate you and everybody else who's trying to find a fee-only advisor. Now, I looked Horizon up. Horizon is strictly an investment advisor registered with the Securities and Exchange Commission. However, reading through their Form ADV Part 2 very carefully, you'll find the following couple of paragraphs. And they tell you a lot about the firm. And what it tells you is that while this part of the firm acts as a fiduciary, the other part of the firm doesn't necessarily. Some people, quote, this is a quote, some people who provide advisory services on behalf of our firm are also registered with Private Client Services Incorporated, a broker-dealer registered with the SEC and a member of FINRA. These individuals offer both investment advisory and brokerage services. Well, that's a conflict. When acting, and listen, here is the conflict spelled out very, very, very succinctly. This is why you need to read these things. When acting as a registered representative of the broker-dealer, these individuals receive commission on transactions in securities, including trail commissions or trailing commissions on the sale of annuities, mutual funds, and ETFs, and a share of certain other fees paid to PCS on client transactions or holdings. Any compensation earned by these persons in their capacities as registered representatives is separate and in addition to our advisory fees. That is a giant red flag. And these red flags are hiding. They have to be disclosed somewhere in these Form ADVs. And that's why these Form ADVs are so important to read. You'll find them, and you can do a search. Once you pull one of these things up at advisorinfo.sec.gov, and that's advisor ER, you can search in your browser for the words compensation, sale of securities, conflict of interest, insurance, commissions, those kinds of things. Look for those words. They are absolute giveaways. And that is why they would not fill out and sign the form. Because if they filled out and signed the form, they'd be lying. And you don't want to lie in writing. Not in a registered, a regulated industry like this. Oh, and by the way, they mentioned that they would get commissions on annuities possibly, but it's also mentioned a little further on that some of the people who provide investment advice on behalf of our firm are also licensed as insurance agents. You don't want a firm. You do not want an investment advisory firm where anyone affiliated with that firm is registered as a broker-dealer, registered representatives, or insurance agents. You don't want it. Because it means they're... if given a chance between making 1% per year gross and making 8% on an indexed annuity sale, or 9 or 10, whatever, and somebody is trying to make their quotas and support their family today, what do most people do? They're not thinking long term. They're thinking, let's see, if I put $100,000 in this annuity, then I get maybe $8,000, $9,000, $10,000 in commission. If I put that same money in an advisory account at 1%, I only get $1,000. It's going to take me a while to earn as much. We're short-sighted, and we're also greedy. So what are you likely to do if you can? Yours is a great call, and it is hard. It is so hard. I congratulate you for taking the impetus to do this now, to find a good firm. But they're hard to come by. I've repeated this statistic over and over and over again, and it bears repeating over and over and over and over again. There was a study done back in, I think it was 2015. It was where was it published? It was published at MarketWatch. They found that of all of the registered financial professionals out there, people who provide financial advice, that, get this number, this is such a shocking number, only 1% of those registered was always required to act as a fiduciary, meaning they didn't have a conflict like being registered as an insurance agent or a registered representative. That means if you meet 100 investment advisors, only one, you meet with 100, only one was always acting as a fiduciary. Whew. Odds, tough odds. And so the onus is on you. I hate to say the onus is on you, but it's certainly worth a lot of work when we're talking thousands and thousands of dollars. You'll be well compensated for your time. Thank you so much for the great call, or the great question, or the great recorded thingy. And I think it's time for another one.
Hey, Don and Tom. Got a question about a fund that's available in my employer's 401k with T. Rowe Price. They've got a couple of low-cost Vanguard index funds on the equity side, but they're just really limited options on the bond side. The only bond fund option is Dodge and Cox Income X, which is ticker symbol DOXIX. It appears to be an actively managed bond fund, but is reasonably well diversified, I think. really don't have any other options in there. I even looked into self-directed 401k, but they won't let us do that. So just wondering what you think of that fund, if it's a, reasonable fund for bond exposure. Thanks a lot. Bye.
Well, if you need a bond component in your portfolio and that's your choice, then, well, I guess they could be worse. I know they could be worse because I've seen bond funds with much higher expense ratios. That Dodge and Cox X fund is a third of a percentage point a year in fees, which doesn't sound high, and it's not terrible. It is for a bond fund because you can compare it to BND, which is 0.03 so it's 1/10 the cost. And that makes a difference in bond funds. When you're talking about 4% returns, a third of 1% is about 8% of your return. So the Dodge and Cox, to be competitive, has to take more risk, and you can see it in the portfolio. The triple B component, the lower rated investment grade bond component of the Dodge and Cox fund, is about 28% versus about 13% for BND. So they have to take more risk to be competitive. That's the way math works. If you're going to buy the exact same things, the fund with the lower cost is going to return more money to you. That's just the way it works. So it's okay. If you have the option to also fund an IRA, I would be tempted to grab my bonds there in an IRA outside of the 401k if you need bonds in the portfolio. Otherwise, it's okay. Great. I would never recommend it to anyone. I don't recommend active management, but it's got a pretty broad portfolio. Again, more risky than BND, in my opinion. Thank you so much for the question. I really appreciate it. If you have a question, go to talkingrealmoney.com. Click the contact form. There you can either type your question or you can speak your question, and then I'll answer them on these Friday question and answer podcasts. And it's just really easy and really free. And I love answering questions. It's my favorite thing. It's what I've been doing on a financial talk show since literally 1988. Just answering questions, trying to get the answers right. Not all the time, but I think track record's decent. Oh, and by the way, if you want to talk with us live, pretty much every Saturday, Tom and I get together with you, or me. By the way, it's going to be the end of June, the beginning of July. It's just going to be me because Tom's going to be in Africa. So 3 weeks, 3 Saturdays in a row, I'm going to need your help in June at 855-935-TALK on a Saturday. Call on Saturdays starting at 3 p.m. Eastern Time, 3 to 5 Eastern, noon to 2 Pacific, and we can talk live. And that's every Saturday, except for maybe Christmas. Once again, let's go to another great question.
Hi, Don and Tom. Thanks, you guys, for the best financial podcast out there. I have a very general question about Social Security. I know you guys are no fans of Dave Ramsey, but he has an interesting talk on Social Security on YouTube. And he says it's probably the only program you can point to that offers a negative 4% return, but yet people would fight to keep it. So my question for you guys is, do you think we'd be better off if Social Security didn't exist, if people were allowed to invest on their own? I see the advantages just in the fact that the politicians could concentrate on things like reducing deficit spending, infrastructure, and national defense, and not really have to be distracted by something like Social Security. And also, you wouldn't have to play this guessing game about when to take Social Security. And also, you'd be able to designate the money that's left over if you die young to whatever charity you choose or to your heirs. Anyway, overall, what do you guys think of Social Security? Would we be better off as a society without it?
This is a great, albeit fairly political, certainly philosophical question, but I believe a moot point. I truly believe Social Security will be with us as long as we have a country, which I hope is a very long time. There's a problem. How do you replace it right now? How do you fix it right this minute? You've got tens of millions of people who are collecting Social Security, and many, a huge percentage of those, it's their only source of income, or it's their primary source of retirement income. How do you take care of those people without new money constantly coming into the system? It has to be funded just to take care of those who are already collecting benefits. Then what do you do to all of those, well, like me? I'm in my 60s now. Didn't think I'd live this long when I was younger. And I would have saved more. But what do you do? How do you take care of my obligation? There's no, you could go back and I could go back and take all the money. Maybe they say, okay, you can have all the money you put in, but wait, that's not going to provide me with the same income because I've been funding the people who've retired before it. I'm gonna collect more money than I put in. Yeah, had you given me the option to invest it and it would have been automatically done for me, I personally would probably have been a lot better off. I put a lot of money into Social Security. But what about those who don't make much, who didn't put much into Social Security? Do you make it mandatory? What if it's not mandatory, then what do you do with the people who said, I'd rather not have that 7.5 taken out of my paycheck, or actually 15 when you throw your employer's portion in. I'd rather not have that taken out of my paycheck. I'd rather just spend it now and I'll be okay later because I'll figure something out. What do you do with those people? Do you literally? I mean, we would have to go to them. Oh, sir, you're 72 years old and you can't work anymore because your legs are shot and your hands are shot and your head is shot. Well, die. Good luck, but die, because we're not going to take care of you. You didn't save. This is not the story of the grasshopper and the ants. We have a moral obligation to take care of those who have been in the system and expecting money from the system. And Dave Ramsey's ideas are, they're pipe dreams. Yeah, it's a system that's lost money because it wasn't designed to make money. Politicians totally messed it up. But what are we going to replace it with? Are you going to tell tens of millions of people, oh, sorry, as of today, you no longer get a check. By the way, all you young people, now you can start investing it. Do you think that would really work? No. We have to be pragmatic about it. It's not, it wouldn't work. Wouldn't fly. You'd have a revolution. A bunch of old people with guns. But thanks for the question. I appreciate it. If you want to send one in, go to talkingrealmoney.com, click the contact form. It's that easy.
Hey guys, this is Jim in Charlotte, North Carolina. I'm just curious about return reports. Like, my annual return report was 29% last year, and I have managed mutual funds. So my question is, was that report before or after the expenses? I'm not sure how to tell. Thanks.
Well, this is both a good and a simple question. All returns quoted by mutual funds are after expenses. It's after they've deducted whatever their annual expenses are, the 0.1%, whatever they charge. They deduct that first, and then they report their returns. So it is after expenses. Thanks for the question. Now, let's do another one.
Hi, Tom and Don. I listen to your show on a regular basis, a new listener, but really have been enjoying it. I have a question about the Vanguard bond fund, BND, and if that could be what you think about replacing that fund with 3 different funds. The ticker, the first one is CLOI, that's the VanEck ETF, CIO ETF. And then the second one is ICVT, that's the iShares convertible bond. And the next one is RCS, the PIMCO Strategic Income Fund. And I'm just wondering if that would be sensible to replace the BND ETF with those 3 ETFs. Okay, thank you. Appreciate it.
Well, thank you for listening. Do you want the short answer or the long one? The short answer is not only no, but hell no. Absolutely no. Whose terrible idea was this change? Potential change. Hope you haven't made it. This is just awful. Awful. I mean, truly awful. I kind of get where somebody's coming from because it sounds like a typical, well, here's a way to increase your return, ma'am. No. One, these are convoluted, complicated funds. Two, they're expensive. BND costs 0.03% per year. It's a massively diversified portfolio of bonds. Basically all the good bonds in the United States. The ICVT, that's the convertible bond one. Well, that's sort of a way to give you the returns of bonds and a little bit of like growth. It's so you kind of get the worst of both worlds. Because it's not really a bond and it's not really a stock. Why not just own stocks and bonds? 2. Oh, and its expense ratio is 0.2%. So it's like 8 times more expensive. We have the CLOI, and it is a bit cloying. It's 40 basis points, 0.4%, and it is collateralized loan obligations. And we've sung this song before. Yeah, they're working right now. That was the thing about collateralized debt obligations and collateralized mortgage obligations in the past. Remember how well they worked right up until they didn't? You remember it was CDOs that took down Bear Stearns and Lehman Brothers and nearly took down AIG and took down banks. And we're playing the same old stupid game again. Don't let them play with your money. And finally, the most stupid game of all, I believe, is played at PIMCO. The PIMCO fund is great, some great bonds, some really cruddy bonds. It's leveraged to the hilt. They borrow money to buy bonds. What does that do? Increases risk dramatically. What else does that do? Increases expenses to the most astronomical level when you figure in the cost of borrowing money, 3.87% per year, according to Morningstar. 3.87% per year. They have to overcome that drag to return anything to you. That is absolutely appalling. At PIMCO bothers me more than almost any mutual fund company in the world. Yeah, they may have a nice yield, but they have a lot of leverage. 76% leverage. No, this is a terrible idea. I hope this is some idiot that you can kind of cut out of your financial life, because whoever this is giving you the most deplorable advice possible. I mean, that PIMCO Strategic Income Fund in 2022, when other bond funds went down 10 or 12 or 13%, that went down 20%. Yeah, it's had a nice 15-year average annual return, but they've taken a ton of risk in doing that. No. And I'm going to go on a little bit longer. We all have to rethink our use of bonds. We do not buy bonds because of the income they give us. That's just a bonus. We own bonds in our portfolio for one reason only: the reduction of volatility, the relative stability. They're not totally stable, but compared to stocks, they're rock solid. BND's worst year was a loss, and that was in 2022. And I want to pull it back up, make sure I'm giving the exact right number. I believe I think it was 13%, but I'm going from memory. So I'm going to Morningstar, and I'm pulling it up, and I'm stalling because their servers sometimes are just incredibly slow. Yes, 13.1. That was their worst year. That was their worst year ever. In 2008, broadly diversified stock portfolios lost about 50% of their value. So compared to stocks, even in the worst case scenario, bonds are stable. That's why you own bonds, not for yield. Do not think about the yield of your bonds. Don't think about it. Own a diversified portfolio without long maturities, because long maturities increase your risk and volatility. Well, volatility is what we're talking about now. So there you go. Thank you very much for listening and for your call. Thank you all for being a part of it. Please, 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 call us on Saturdays if you want to talk live at 855-935-TALK, 855-935-8255. Tom and I are together on Saturdays taking calls live on our radio show in the Seattle area, and we do it between 3 and 5 Eastern, noon and 2 Pacific time. Also, follow along on the summer road trip at TalkingRealMoney.com. If you want to meet with somebody, including Tom, for free for nothing with no obligation and no sales pitch, promise. Just go to TalkingRealMoney.com, click the Meet an Advisor button. I think that covers it all. Thank you all so much for being there. Tell a friend or 1,000, and we'll be back together soon doing that really important thing we do. You know what it is. It's Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?